I buy houses every day. So this is what I'm doing. So today is my pleasure to talk at Google and tell you some know-hows about house hunting. Just like Eric, I think maybe a lot of you are working from home because of COVID-19. But how many of you have noticed that the housing market in 2020 in the US market has grown over 10%? Of course, this is because of the low interest rate we have observed. And another reason is because the lack of housing supply. And the pandemic has pushed a lot of people flood into suburban areas, such as a lot of friends from New York, after pandemic, moving over to New Jersey, Atlanta, some area, Florida. It seems like suddenly everyone is buying houses. So for me, I'm running a real estate investment fund in Atlanta. And sometimes I'm putting offer and actually I'm bidding a house competing with another 30 offers in the market. So it's a quite hot market. And if you are also considering about buying an investment property today, I'm gonna give you an overview of real estate investing and provide you a simple framework and tool of how to analyze real estate investment opportunity. So let's start with what is a good investment? So if you want to buy an investment property, what would you consider in terms of making a decision? For my fund, I would say three things, which is good buy, good management, and good exit. So for individual investors as well, I think it's the same thing because real estate investment usually involves a large amount of capital. For example, if you buy a house, it has to be like at least $300,000, $500,000, especially in California, $1 million something. So, and it's also time consuming for the transaction period. So once you put your down payment, the investment is not easy to reverse. For example, you buy a house today and close it, and you change your mind, and you probably cannot sell it in the next day, right? So a good investment is largely determined by whether your investment is a good buy. So today I will only give you a very practical framework of how to make a good buy. So let's talk about what is a good buy. So first of all, what is a real estate? From the name, you probably can tell it's an asset that is real, right? So it's visible, it's touchable, and livable. First category is residential. It's very common to see for you guys because it's just a house you bought and live in. Very common. And commercial real estate, from investment perspective, is also viewed as a hybrid of investment featuring both bond and stocks because it's not subject to the stable cash flow, just like the bond fixed income interest, but also the property appreciations like the stock price increases. So that is how real estate is so interesting to a lot of people. So now question, what category you think the apartment building is? It is commercial, it's not residential. Maybe from your common sense, it's still like a residential building, but as a landlord of an apartment building, you're collecting rents from the tenant every month. So the asset is actually an income producing asset. All right. Next, let's talk about where to buy. You may hear a lot of people saying like real estate investing is all about location, location, location. So levels of the factors can be very large scales like global and national, and small scales like a regional, like a southern area of US, or local market like Atlanta, Charlotte, or Fulton County, whatever city, zip code, right? So from a global level, for example, a weekend, the US dollar, the currency will attract more foreign investment to the US. And at a national level, interest rate, GDP, supply and demand will also determine the direction where the home prices will go, rents go, and vacancies, stuff like that. And at local level, for example, local population growth, demographic changes, where the people moving from. Like a lot of people now you see from California, Elon Musk is moving the headquarters to Austin, for example. And sometimes the household income to determine whether this neighborhood is a wealthy one, and determine where is the neighborhood you want to buy the property in, right? So because all of the factors above eventually determines a real estate investment's projected key assumptions. For example, vacancy rate. Vacancy rate is basically, say you have 100 properties and 10 of them are vacant, 90 properties are occupied by tenants, so the vacancy rate is 10%. And another thing is price growth and rent growth. So those are the key assumptions you're gonna take for evaluating a property's return from a valuation perspective. So when you think about where to buy, you're actually doing a comparisons between the market by using the metrics of the factors above. All right. Next, so we're gonna take a look about a real case study. This is what SeaStar has done in the market picking for the best single-family rental market. We use the metrics of factors to compare between different markets. We picked Atlanta, Charlotte, Dallas, Miami, New York, Los Angeles, San Francisco. You know, those are very popular markets right now. And our strategy is trying to find the best rental housing market with not only the higher yield, the higher cash yield, which coming from the rent revenues, right? And also the potential growth in terms of the rent growth and price growth. So we're looking at median home price because affordability is a key factor for a strong rental demand. And we're also looking at home price growth, rent growth, and the rent to price ratio. Of course, the Q-rent ratio is also a key important factor for us to consider whether this is a good market to invest. So what is Q-rent ratio? This is a special term defined by SeaStar, by our company. It's actually the rent to price ratio minus the property tax rate. Why this Q-rent ratio is so important for us? Because for some investors, they may ignore the property taxes. However, the property taxes can be very, expensive and eating up your revenues and making your net income, reduced. So, for example, Dallas, you see the rent to price ratio is 7.1%. However, the Q-rent ratio after deducting all the property taxes down quickly to 5.3%. So that's why we have to think about property taxes factors in terms of across the market and how it impact the property's yield. Okay, and we're also looking at the demographic data, for example, population growth, employment growth, and we're also looking at the median housing price from the last peak to trough. So this is an interesting number as well because it really is an indicator of how the markets performed during the recession period. So when the recession hit the market, different market will show different price drop. For example, Miami and Orlando, those are two major cities with major populations from tourism and vacations and retirement. So it's kind of not a very complex mixed industry metrics in this economy composing, right? So when the recession hit the market, the home prices will be hit big. That's also some factors we're thinking about to avoid in choosing the market, because we're not only thinking about the good market. The good market is always performing, like you're making money, but what about the bad time comes, right? This is some risk that you have to think about when you consider where to buy. Okay. Let's take a look at how the supply and demand affects the housing price. This is a housing supply index from a long historical view from 1963 to 2020. The supply index is how fast you can sell your house. If you put it on the market, say the index marked at 6, that means it probably will take you 6 months to sell the house if you put it on the market. So now you can see that the U.S. housing supply is at a very low level. It's probably the lowest level for the past 57 years, right? 57 years is a long time. So that's why you experience, maybe if you buy a house now, you feel like it's so competing, like the price is so high, and because the supply is so strained. So from supply demand perspective, as of today's market, the housing prices probably will continue to grow, especially in suburbs, due to the population movement from urban to suburban areas. Okay, let's take another look at how the inflation affect the home price. The nominal home price is actually the sale price when you sell a house in the real world. Say you buy a house for $150,000. So that is the price you pay. That is the nominal home price. Real home price is an inflation adjusted price, which appear to be more cyclical, moving along with our economic cycles. You can see that during the last 4 recessions, the nominal home price only dropped once. That was the last 2008, right? This is because this is due to the real estate lending sector, the real estate default, and initiated from this sector. So you do see that the nominal home price dropped. However, other than that, the nominal home price kept growing even during the previous 3 recessions. So this is because real estate inflation hedging sector is also a charm of real estate for a lot of investors against economic cycles. So think about it, if you have a $1 million in your bank account, considering the current situation of economic inflations, for example, the lower interest rate, and also, the monetary policies from government printing money in 2020. Think about that. So now you have the real estate asset class to hedge the inflation rather than just holding cash in your bank account. All right. So now you probably have built a framework of what to buy and where to buy. Before we talk about the calculation techniques, let's take a quiz. Look at those 2 beautiful houses. One is in Austin and the other one is in Atlanta. Assuming that both of the house will cost you $200,000, okay? Okay, so the rent in Austin is lower, but it can sell at a higher price in 3 years. I can tell you that the IRR is the same. It's the same at 15.4%. So maybe IRR is not familiar to you. I will just give you some explanations. IRR is a metric used in financial analysis to estimate the total annualized return for a potential investment. So you can just take it as a total return yearly and annually, right? So it looks like the return is the same. The question for you now becomes whether you would choose a higher rent house in Atlanta or you want to choose a house that can sell at a higher price in Austin. It's a very challenging question, but I think my answer will be the second one. Why? Because assuming all the other factors are the same, the risks associated with these 2 investment opportunities are totally different. Because the rent yield, you can see that we have the formulas calculated for both of them. The rent yield is relatively stable and certain over the next 1 year. If you sign a 12-month lease with a tenant, right? Think about that. You can, as a landlord, you can collect the rent every month from a tenant because you have a lease. You have something legal binding in your hand. However, how much you can get from the price appreciation is nothing guaranteed, right? Because the growth is subject to more uncertainties of economics and the market volatilities. So when we talk about the return, we actually talk about the risk-adjusted return. In this case, for the Austin house, the first one, you actually bet on the back-end appreciation when you sell the house in year 3. Year 3 is in the future. You don't know about that. Well, the Atlanta house, you get a large portion of the money back already during the holding period for the first 3 years. So that's why I bought the second house for our first fund. All right. So in the real estate investment world, people are more used to use the term like 4 categories of risk profiles. That is core plus, value add, and opportunistic. So question, what do you think a core asset would be like? How does a core asset sound like? It's core. It's like very stable, right? I would say an office building leased to Google in Manhattan is a core asset because Google is a great tenant with high credit rating. It's just like a bond alternative, right? Think about it. If you are a landlord, lease, your office building to Google, you can just very happily enjoy the monthly rentals, collecting the rent from Google every month, and you do nothing, but you just collect the rent every month. And of course, the return will be in the low range, probably between 3 to 5%. The return is lower, but it's safer because the risks associated is also lower. All right, so let's go up with the risk curve. Theoretically, the higher risk to bear, the higher returns you would be subject to. That is very hypothetical. It's supposedly, but not always the case. So in the world. So generally speaking, there is no absolute good or bad investment. It's just about how much return you are expecting and how much risks you can bear. So when the return matches the risks, it's a decent investment. So next time when you saw a core or core plus asset that can produce a value add return, I would say that's a good opportunity that you definitely want to put your money in. Okay, so now you have a concept. You have a concept of the risk-adjusted return. How to do a back-of-the-envelope calculation about how much of the return, right? So next, let's do some technical exercise. So first of all, let me introduce a key terminology, cap rate. I learned this term from the first year when I was a student of a real estate in master school, and every single real estate professional knows about that. So it's a really important term. It's actually a percentage computed based on the net income, which the property is expected to generate every year, divided by the property asset value, which is the purchase price, right? So it's a percentage. It's very useful to estimate the investor's potential return on their investment. Okay, how do you think about the cap rate of an office building in Manhattan compared to the cap rate of a warehouse in Oklahoma? Okay, of course, the cap rate of Manhattan office is lower because Manhattan is expensive, right? Expensive in everything. You pay higher prices for goods, for clothes, and for products, and you also pay higher prices in real estate in New York than Oklahoma. So that's why, the more expensive, the cap rate is lower. All right. Let me introduce another terminology. A lot of terminology I know is boring, but I mean, trust me, it's the faster way to calculate the return. And when you compare two investment opportunities, you actually don't need Excel like a lot of real estate professionals do to run the cash flows of complex models. You can just use this formula, like back of envelope calculation. It's very easy to use, so very helpful. Hope you can learn it. Of course, you would apply for a loan, right? You would apply for a loan if you buy a house or an investment property. That's called a leverage. But the unlevered IRR is good enough to give you the idea of your return already. For example, when you bought a house as your investment property, you probably know how much it can rent and how much you can purchase it, right? The purchase price. And then use the formula cap rate. You can calculate the NOI and the purchase price. And then you come down to the cap rate, say 7% in this case. Then you can assume the housing price in your neighborhood will grow 3% every year. Now, the total return you can get from this investment will be adding them up, so as 10%. So that's how we calculated the total return on an unlevered basis. It basically means you're just assuming that you buy this all cash without any loans, and this is comparable because you can just compare two investment purely apple to apple, all of them assuming no loans, right? It's just purely based on the project's performance. All right. So next, we're just going over, some underwriting case studies. This is a real case for our Fund 2, a single family rental house. We bought this house in 2020, and it's a 4-bedroom. The total size about 1,800 square feet. And we use $170,000 to purchase property. And you have to pay like a closing cost for legal cost and, property tax, transfer taxes, all of those as a closing cost. And we do a little bit of renovations, which called capital improvement, to improve the value of the property, because every single dollar you put on the property can deliver a better, quality and increase the value of your investment. So our total acquisition cost is about $185,000. And of course, we apply for a loan at 65% loan to value. The loan amount is about $115,000. And the lender will charge you a fee upfront for the loan fee. It's about $4,000. So our total equity out of pocket is $74,000. Let's take a look at the annual cash flow. The cash flow composes 2 parts. I would say the first one is the revenue coming from the rent. So we rent out the house for $1,600 per month. So the yearly annual rent revenue is $19,000. And then comes down to the expenses part. So this is something that you have to think about when you manage the property. You have to take out, the repair and the maintenance cost, because sometimes something broken, for example, the toilet is leaking or plumbing needs to be fixed, the carpet needs to be replaced, or painting on the walls, all of the work, you have to budget it a certain amount of money for repair and maintenance. And then you have the property taxes. We have to talk about the property taxes can be different from market to market, depends on the state and the county, compliance and codes. So we also, recommend that you guys, if you buy investment property, pay more attention to this number, because it's sometimes ignored by investors. So in Georgia, which is a good thing, is the property taxes is relatively lower compared to the price. So for example, this house, $178,000 is probably only 1.3% per year at $2,500. That will help you on the cash flow yield, because the property tax will eat less from your revenue, and it comes more to the net income. And then you will have the HOA, right? The HOA is a cost usually referring to the homeowner association fee. So it's kind of, if you buy a condo or townhouse or even community, the property management will take care of your snow removals, or the roof replacement, some other garbage disposals, stuff like that, and the fees for the common areas. A good thing for single family is, a lot of most of the single family doesn't have any HOA. Rather than like if you buy a condo in Manhattan, it is usually charge you like over $1,000 per month for the HOA, right? So that's also some cost associated. You have to budget it to think about the cash flow thing. The next thing is the insurance. Insurance is something that usually homeowner will buy, but as an investor, I would highly recommend that you will also purchase this insurance as well, because as an investor, you're gonna lease out your house to a potential tenant, and the tenant sometimes will, have things to do with the house and maybe sue you, or something happened, maybe a fire, for accident, for gas biz, the gas reasons. So the insurance will protect you from not only from the replacement cost of the house, but also from the general liabilities. It can, save you if there is a lawsuit. So insurance is also part of expense when you purchase an investment property. And next thing is the property management. Property management usually is a function that you are working with a team, the person who help you to collect the rent and talk to the tenant, looking for potential tenant if the previous tenant left the house. So they're doing the works and also help you to find the vendors or the repair people to take care of your repair orders, the tenant repair orders. So those are, property management companies' functions. Usually they charge a fee on the percentage of the rent. Definitely it depends on where your investment property is. So usually like in the southern markets like Charlotte or Atlanta or Dallas, it's 10% of the rent per month charged to the landlord. But for us, we because we're in-house property management and the economic scales help us to lower the property management fee as well, down to the 6% per month of the rent. Okay, next is the capital improvement and also called CapEx. Is something that something happened to the house and you need to do some capital improvement to the property to maintain the value. For example, the roof or HVAC. The HVAC is the AC system, right? The furnace, stuff like that, it needs to be replaced. And those items are not simplized repair items from a tax perspective, because when you replace a roof or HVAC, it can be amortized over years, and it also increase the value of the property. So that's why it's separated as a separate items from the repair and the maintenance item. And then the leasing commission. The leasing commission, basically you pay to the agent who help you to find a tenant, or once the tenant renew, the leasing agent also get a pay when it sign the lease on behalf of you. So I would think that single family rentals compared to apartment has definitely cost efficiencies in the leasing commission part, because think about it, if you live in an apartment, usually you sign a lease for 1 year or 2 years. And because it's very easy just to bring a luggage to move in and move out, tenants tend to, have a shorter term. But for a single family in the suburban house, people with families usually, and they have the kids go to school and very sticky to the location, and they have more furniture, they enjoy more spaces, they have 3 bedrooms. So sometimes they don't, want to leave the house within 1 year, 2 years. Usually the average lease term for them will be 3 to 5 years. So that means the leasing commission can be saved, the second year and the third year until the point the tenant doesn't want to renew your lease. So it pretty much annualized the leasing commission on single family rental is very cost efficient. And then we come down to the net operating income, that is NOI, right? So in this case, it's $13,000. So we have learned the cap rate, which is NOI divided by the purchase price. In this case, it's 7.42%. And then we have to pay the debt. And after that, net cash yield is 9.21%. So assuming that we're holding this property for 3 years and we want to sell it at a good price, assuming the price of appreciation is 5% per year, we will grow to $206,000 when we sell the house. And for us, we also enjoy a 15% portfolio premium, because our exit strategy is sell to the institutional investor as a portfolio. And then we have 3% closing cost. It's also lower than individual houses. If you want to sell on the market individually, you have to pay selling agent and listing agent, both 3%. But for us, we're working with commercial brokerage, only costing us 3%. So then you have to pay back your principal. Your loan balance is $115,000, and total property appreciation gain will comes to $114,000. So now we come down to the gross IRR, is the net cash yield plus annualized return from appreciation is 24%. So this is a simplified version of underwriting analysis, but I hope it can be very helpful for you to analyze your next investment opportunity. You can use it, as a back in the envelope, and for your calculation of the return, the cap rate, and the gross IRRs. yeah, hope this helps. This is all I have for today. If you need the slides or any questions, feel free to contact me. This is my email address. Thank you so much. This is for today.
Yeah, thank you so much, Jerry. Definitely learned a lot there. I think my biggest takeaway was I need to move to Austin or Atlanta to buy a house for $200,000 because that's not what housing prices go for here in the Bay Area. So cool. We did have a bunch of questions. Maybe we can go through. I will present. Oh, that was not what I was trying to do. I will present my screen here in a second. Let me paste the Dory again in the chat. Remember, because we're YouTube, smash that like button on any questions that you like, and smash that thumbs up if you like this presentation as well. Oh, whoops, that was not the Dory. This is the Dory. Oh, yeah, it's in the calendar invite as well for folks who maybe joined a little late or are on the live stream. So yeah, that's the Dory. I will start presenting it right now. One tab. So share Dory, right screen. Yeah, you guys don't want to see my other tabs. It's all boring data stuff. But cool. So first question, one of the ones that I had seeded. So Sherry, why would someone choose to maybe like invest in a real estate fund or REIT instead of buying their own property?
Okay, great. This is a good question because we do feel like, you know, a lot of people buying their own properties. But when you buy, invest in real estate fund or REIT, you actually join a large portfolio instead of, you know, a single asset. So when you purchase a share of the REIT or real estate investment fund, you actually purchase a part of a share of a larger portfolio. So that means you have a better diversification of locations because the portfolio may uncompress different markets. Like you can have 6 or 7 markets in the portfolio, and you can probably have 100 or 1,000 or 10,000 properties in this portfolio that also, you know, leasing to different tenants, and tenants have different profiles and qualities. So, you know, once the portfolio is diversified, your risk is lower. So that's number one. And number two is, I think, you know, from my experience of the property management and asset management, usually a larger portfolio enjoys a better economic scales. So for example, the repair cost and property management fees will be much lower than you know, the individual houses you will manage through a third-party property management. Just like not only from the 10% fees and down to 5% or 6% of the rent per month, but also, you know, the repair cost when you send somebody to fix a toilet for you, for example, you get a bid from the vendors like $100 or $150, but for us is probably $50 to $60 because we work with the vendor all the time, and we have a discount from him. So, you know, we also, you know, we're working with a large amount of the vendors, so we can pick the best one always. So that's the economic scale. That's number two. And number three, I always think about, you know, the exit premium is different. So for example, the REIT, the exit can be, you know, going IPO or taking public, so you can enjoy exit premium. For us, we also sell to REIT, you know, for example, institutional investors, and we can, you know, sell and enjoy the arbitrage from the purchase from the retail market, and then exit to some larger investors, and then enjoy the pricing difference, because larger investors usually have a lower cost of capital, so they purchase, you know, at a lower cap rate. That's the terminology we use again. So that's how, you know, we evaluate the spread and then enjoy the profit.
Cool. Yeah, thank you for that answer. I think one, if I add maybe a point there, while looking at the underwriting case study, I think maybe one benefit is someone else does all the math and does all this work for you. Definitely looks like a lot of work, especially if you know, you're only going to be buying one property. So definitely lots of work that, you know, someone else can do on your behalf who is a professional and not, you know, someone who's just buying their first property like me. Cool. So second question from Brandon. I believe this is he's in Bellevue, and the question is: as someone who is looking to buy property for primary living, would it be safer to buy it after the pandemic is resolved and wait for the housing market to cool down the next few years? Yeah. So
Sure.
take it away.
I think from macroeconomic perspectives, I think the inflation, first of all, the current situation of the economics is it probably will you foresee a large inflations in this year and next year. First of all, the lower interest rate, a lot of hot monies to flood into the capital markets. And especially the government has printing monies for QEs to help the employment and small businesses last year. So the inflation has already affected the home prices. See the housing prices growth over 10% nationally, and especially some market in southern areas. In our investment market, we enjoyed 18% increase year over year. So that is something we observed from a macro level perspective. And of course, if you want to buy a property for primary living, it also depends on where you buy, right? We talk about where you buy, and especially like the pandemics pushing people from urban areas to suburban areas. You do see, for example, I used to live in Manhattan apartment after pandemic. I moved back to Princeton, New Jersey, and that's a suburban environment because they enjoy more space and outdoor activities, more safer and less contact with people. So that make people thinking about where I'm supposed to live. New York City condos probably, suffered a lot last year, especially like condo prices or apartment rent in rental markets has over 40% of vacancies, rent drops as well. So it really depends on, where you want to buy. If you want to, buy in suburbs, especially in the southern market including the Sun Belt areas, for example, Atlanta, Charlotte, Dallas, Austin, Las Vegas, Phoenix, Houston. Those are the markets a lot of people like moving in. If you see the population growth numbers, the last the pages, Atlanta market, the population grows 3 times of the U.S. average, and Charlotte has 4 times of the U.S. average. So follow where people are moving is another thing you can think about where to buy as well, because the population definitely brings in a lot of consumers, consuming goods and of course housing stocks. So that's how you see the housing price increase over those areas.
Cool. Yeah, thank you for that. Yeah, it sounds like there's a lot more to consider than just COVID. And in the pandemic, it sounds like in more urban areas, housing prices have gone down. In suburban areas, housing prices have gone up, and it seems like it's pretty safe in either sense because of the inflation. But like you said, there are so many other factors to consider than just the pandemic itself. So maybe like we have to take a bigger picture look at the market.
That's right.
Cool. Yeah, the next question for me was basically the same question, so we'll skip it. And the third question I seated here, thank you all for liking my questions, is that we all work here at Google. Our stock has grown 43% in the last year. Why would someone choose to invest in? Yeah, thank you. I don't have much because I joined a year ago, but still happy. But why would someone maybe choose to invest in real estate over just buying Google shares, especially given that we're Google employees?
Yeah, first of all, that's very impressive. That's very high numbers, sky flying. Congratulations if you buy your Google stocks. I think if you want to really compare, if you buy Google stocks or some other stocks and real estate, I think from perspective of like an investment, not only from the return perspective, like a percentage, like how much return I got per year, like a 43% or 20%, like our fund to deliver, but also something like how much money, like a total amount of money you can earn by holding the stock. So, another thing is consider like real estate is a relatively constant, cash flowing asset, constantly delivering a 20% return every year. If you hold 4 years, annualized every year is 20%. You hold 4 years is 80% total return. So say you have $1 million to invest into either stock market or real estate. For real estate, you're holding 4 years means you can earn $800,000, right? 80% of the return. But if you want to hold Google or some other stocks, the first year probably 40%. But what about the next year? Probably the stock volatility will change, and the economic foresees and the projections will affect your returns as well. So I would say that real estate is relatively not only from the cash flowing stable assets, but also price appreciation, inflation hedging, and constantly can delivering every year, returns. So that's investment tools that can utilize for longer term. I would say if you think about investing something, in a longer period and getting a better returns, not only the number of the rate, but also the amount of the capital you can earn. Real estate definitely is still something that you can consider.
Mm-hmm. Awesome. Yeah, thank you for that. I think my key takeaway there was that you get more consistent cash flow, and it's based in like a real asset. So the cash flow is more stable kind of across multiple years. Whereas if Reddit somehow decides to send Google to the moon, it'll go up, and then in the last 2 days, GameStop went down 85%. So a lot less room for speculation there. Awesome. Another question here from Arthur in Mountain View. Do you recommend investing in property far away from your primary residence? I think most of us here are in the Bay Area, and a lot of the examples we've covered are in Austin or Atlanta, Dallas. So yeah, what are your thoughts here?
I think if you really want to manage the property that yourself manage the property as your investment property, I think it's better to be located nearby because it's easier to take care. Like anything happens to the property, you can just go there and check it out and take care any repairs or insurance coverages, calling anything to take care. But you can always find third parties. Property management if you want to invest some market far away from your primary residence. For example, you can use a third-party private management, or you can invest with the investment fund like us. For us, we can take care, all the investing cycles from investing, asset management and asset and exit. So it's like a full cycle services to manage the capital for you instead of like, a specific property. So I think there is multiple choices you can choose from in today's market because they're all available to you. And sometimes you just have to make decisions like, well, what is the risk-adjusted returns you can get from, from this type of investment?
Got it. Yeah, I think that makes a lot of sense. So, if you do want to manage the property yourself and, maybe save on that couple percentage points of fees, maybe buy something closer to your primary residence. But, here the rent ratio in the Bay Area may not be great given how expensive things are. So if you do want to invest further away, I think the advice here is to use a property management company or invest in a real estate fund that will do it on your behalf. Awesome. Next question here from Hari in Sunnyvale. How would one determine what percentage of their assets to invest in REITs? And I think REITs here maybe covers, real estate, maybe REITs and property in general.
I think that's a question regarding fund management. Like if you take a real estate or REITs as alternative investment, how many percentage? I think 20 to 30% probably in a portfolio. Like if you own multiple asset classes, stock, bond, and real estate, I think 20, 30% probably a good number. So especially real estate alternative and inflation hedging also, the correlation to stock markets is very low. Its beta is very low for certain sectors, especially for us, we're investing in single family rentals and the rental yield is constant no matter when the recession happens or the bad economics timings comes. So the rent keeps going, especially over the cycles, because first of all, the housing market is a necessity based product for people's life, right? People needs to find a place to live, either buy or rent. So when the recession hit the market, probably less people to purchase houses, but the more people to rent. So you feel like more rental demands on the market is especially during the recessions, that make up the rental yield drops. I think when you think about the allocations, you probably think about different features of real estate assets compared to some other stocks, asset classes.
Yeah, thank you for that. Yeah, sorry, go ahead.
Yeah, also depends on the timing wise of, for example, now probably you think about real estate is better because I read the news, U.S. news have a poll like how many percentage of the U.S. Investing in stock and how many percentage investing in real estate is probably 28% investing in stocks of all U.S. investors and 26% of U.S. resident investing in real estate. So it's relatively like very close numbers of the investors choosing both sectors, but adding them up is already more than half of the investors in the U.S.
Yeah, thank you for that. I think my main takeaway there was that there are different benefits to investing in real estate versus investing in stocks. So maybe it depends on how much risk you're willing to take, and then how many returns that you want. But it sounds like at least some percentage of your assets should be maybe in this more consistently delivering asset class. Cool. Next question from Kushan also in Sunnyvale. Is it a good idea to buy a second home as an investment?
I think definitely yes. So a lot of people like buying houses as investment properties. Is actually $3.1 trillion market as size in the U.S. So $3.1 trillion single family rental houses in the U.S. That's larger than any other commercial real estate asset classes. For example, all the office in the U.S. is composed of probably $2 trillion, and hotel is less than $1 trillion. But only the single family rental houses owned by individuals and institutions has been $3.1 trillion. So it's a large market, and a lot of people thinking has been doing this for livings and for investment purposes. And it's also a good choice to buy, especially today's market, to enjoy the inflation and also the lower interest rate.
Awesome. So I think that the answer is yes. Obviously, maybe some bias being a real estate investor, but yeah, I think it is a huge asset class and even bigger than Google's market cap, which we don't see very often. Cool. We have a question here from Ruben in Mountain View. How would you account for regulatory burden? So rent control, evictions, and then there's a question specifically here about how did the COVID eviction moratorium impact the rental market?
Wow, that's a great question. So that is something that eviction memorandum to affected the rental markets. And right now the regulations has pushed off the eviction bans to by the end of the March, and not sure if that's going to be extended. It depends on the COVID situation. So that comes down to the question is, this is definitely a risk because if the tenant doesn't pay you the rent as a landlord, how are you going to do with it? You cannot evict and you cannot collect the rent. It's a loss to you. So for us, how to avoid this risk is basically, first of all, when you pick the tenant, you have to, do a thorough background checks. For example, what we do in our fund is, we have an application portal asking all the tenants to make application online, so they have all the informations like social security numbers, name, historical residence, and we can check their backgrounds, criminal records, eviction records, or credit card payment history. So make sure that this person is a decent in the credit payings. And secondly, we check the incomes. We require 3 times of the rent as their income. For example, our market is mostly renting for $1,500, and 3 times of the rent will be $4,500 per month, and their annual income will be like $50,000 or $60,000 per year. So $50,000-$60,000 per year is actually the median income in the U.S. And that's where all the majority of the rental demands come from. That's the middle class. That's the the renters who are not able to afford to purchase a house, but also they have a very stable job, like a pay stop jobs. So we do feel like this trend is more safer, like much safer than if you trying to buy a $1 million house and in San Francisco or in New York, and you're renting for $5,000 per month or something. It's risky. It's riskier because sometimes the people will face like I cannot afford anymore because it's really expensive. And also, those people, if they have the cash, they probably can enjoy the lower interest rate and they can exit. They don't want to lease anymore. So so that's how you have to target your market and your audience of the tenants pools and the background checks of the tenants to avoid any situations like the tenant doesn't pay you the rent.
Mm-hmm. Yeah, that's a great answer. Thank you for sharing that, Sherry. I think so it sounds like it's a very big risk with eviction, and the ways to manage that risk would be picking good tenants, picking them in good areas, and then also making sure that you're renting out kind of relatively, on the lower end of the market. So more like $1,500 a month as opposed to, a New York condo apartment that goes for, maybe $5,000 a month.
That's true. Mm-hmm.
Cool. So next question from Rodney, who's actually in Atlanta. Can you tell me more about your funds? How does one go about playing? I think he uses the word playing into these funds. I would use maybe investing into these funds.
Gotcha. Thank you for asking us. Seems you're interested. Okay, so our fund, we focus on investing in single-family rental houses in southern areas, Atlanta and Charlotte. We have been doing this for 3 years. Right now, we're managing like over 80 properties in Atlanta market. Our strategy is to, investing enjoying the cash yield, usually like about 10% of the gross yield plus, about 5% of the rent growth or price growth per year in this market, largely because of the population growth here, which means dramatically people are moving around in the country, from East Coast, West Coast. They want to move over to some affordable places, even for their business. Their operating costs will be lower and reduced. So attractive to a lot of people coming here to work, relocating, or business to establish new locations. For example, BlackRock, usually headquartered in New York, and then they have a second one in Atlanta. And Facebook, and I'm not sure of Google, but Amazon also have established their presence for distribution logistics centers here in Atlanta. So that's how we, analyze the market, and we position ourselves as investment opportunities to hold for 3 to 5 years, and then enjoy the stable cash flow. And then after 3 years, we can, sell the whole portfolio to some larger institutional investors, for example, some REITs, and a lot of REITs on the market, majorly, focus on single-family rentals, especially today's market. And especially 2020, single-family rental has showed very excellent performances compared to some other commercial real estate. For example, the rent collection rate is above 95%. And retail market, like retail shopping centers, and is only collecting 35%, 40%. Hotel is got a very big hit as well because of COVID. So a lot of institutional investors for example, Brookfield is a very major private equity firm. They never invest in single-family rentals, but in 2020 they established a $600 million fund to the single-family sector. And JP Morgan also partnered with American Home for Rent and increased their capital from $300 million to $500 million investment partnerships with the public REIT. Increase their presence in the sector. So it's very attractive sector now, and that's our also strategy is to take care our investors' capital monies and put into the pool and also enjoy the diversifications. Portfolio income stable quarterly distributions. We have distributed over 6% annual distributions for the last 3 years, and we enjoyed also price appreciations, equity appreciation, net AVV, net asset values increases also.
Cool. So it sounds like your funds are doing well. They're focused in a good area where you did a good buy, you're doing good management, and there's a great exit opportunity. And we're right at time here. So how would one go about investing in your funds?
I think we're taking capitals now until by the end of March. So our second fund will close by the end of the March, and our minimum ticket will be $100,000. So we will send you materials and subscription agreements, operating agreements to sign. That's how you really take seriously into the fund. So if you are interested, I think you can contact me by email, and we can talk about further.
Awesome. Cool. Yeah. And apologies to everyone. We didn't get to all the Dory questions. I do want to be mindful of people's time. So we'll see if we can maybe respond to some of those via email. But thank you so much, everyone, for coming to this event today. It was once again presented by Asians at YouTube. Remember to subscribe to our mailing list, not YouTube channel, if you like this content and want more kind of financial and other types of tips. Yeah, so thank you everyone for coming, and thank you again, Sherry, for the great insights today.
Great, thank you, Eric. Thank you very much, Googlers.
Yeah, thanks everyone.
Thanks.